Social inflation. It's what happens when more and more people sue insurance companies to get more and more money. Sounds like a good deal, right? Unpopular opinion, I think it is actually a very, very bad deal.
Something is wrong with the way, and I don't know why. Why? How do you get by?
Social inflation is not a new term, but its buzzworthiness has skyrocketed over the last few months. I feel like there were sprinklings of conversation about it over the last couple years, and then last October, travelers made the loss reserve change heard around the world, adding hundreds of millions of dollars, sending a pretty big signal about what they expect to happen on the loss side. Traveler CEO Alan Schnitzer cited the challenging level of social inflation, describing a tort environment that has deteriorated beyond our elevated expectation. And all of a sudden, people like me who weren't paying attention were suddenly paying a lot of attention. And apparently I was late to the game on this one. Robert Berkeley Jr., CEO of W.R. Berkeley, advised that he's been watching it for 3 years, stating that social inflation is real. It is here and the industry is beginning to pay attention. So what is social inflation and what causes it? In 1977, Berkshire Hathaway's Warren Buffett described social inflation as a broadening definition by society and juries of what is covered by insurance policies. This means covering things insurance policies were not written to cover and paying more than insurance policies were designed to pay. Usually this happens in court. And to be fair, this doesn't just happen to insurance companies. I mean, who can forget that McDonald's case from the mid-90s in which a woman sued after getting burned by hot coffee? And not for like $1,000. The jury awarded her $2.8 million, which is probably why companies of all sizes are now terrified of being sued and overlabeling everything. I bought a reusable coffee mug the other day that had a label on it saying, "Attention, contents may be hot." And I'm like, yeah, I know. I'm the one that put the contents into the mug. So if I had to guess, I would say that McDonald's and its insurer had not factored a $2.8 million hot coffee lawsuit into their financial planning that year. These mega payouts, which primarily affect the commercial line side of the insurance industry, wreak havoc on loss ratios and, in turn, rates. And they are increasing. Verdict Search's database shows a more than 300% rise in the frequency of verdicts 20 million or over in 2019 compared to the prior annual average. There are a number of factors that play into social inflation, but the most often cited are litigation funding, regulation, and public sentiment. First up, litigation funding. Now, my sister is a lawyer, so I'm gonna be real careful what I say here. Lawyers are good and necessary, but when lawyers and law firms and litigation financiers get involved in claims, it is not always good. It is not always for the benefit of the insured and or justice in general. Litigation funding happens when investors pay plaintiffs to sue large companies, often insurers, in exchange for a cut of the proceeds of the verdict. The practice is not new, but it is rapidly growing. Litigation funding grew by 200% between 2012 and 2018, and is now considered a mainstream method to fund litigation. This results in more cases going to court than would otherwise go to court and higher payouts. Analysts at Credit Suisse estimate that litigation funding adds about $3.8 billion of additional costs into the US court system each year. Legislation. Let's talk about tort reform. The legal definition of tort is messing up bad enough that judiciary type people decide you need to pay cash money to fix it. Okay, that's not like exactly it, but basically the gist. Here in the US, this varies quite a bit from state to state, but the overarching theme is states' regulations being modified in favor of plaintiffs. There is a trend to allow more time for lawsuits to be filed, as well as increase the monetary caps for punitive and non-economic damages. So in many areas, insureds have a longer time to sue and higher potential payouts. For insurers, this equates to higher loss costs due to longer litigation cycles, defense costs, and also potentially higher jury awards. And public sentiment. Between the financial crisis of the 2000s, high-profile scandals, and an increasing wealth gap, Americans have never been more resentful and distrustful of large corporations. And as Insurance Journal wrote, people are more litigious right now because they're angry and apparently vengeful. Much of the coverage of social inflation alludes to a cultural shift in the United States to a culture of blame. And who better to blame and make pay than a large corporate enterprise? Mike Hudzik of Swiss Re shared his thoughts with Business Insurance, stating that probably one of the biggest drivers of social inflation is the general anti-corporate sentiment that exists, reaching back to the financial crisis. And insurance companies are definitely right in the crosshairs. We sell an invisible, complicated product. Easy to see how we get a bad rap. So is social inflation the biggest threat to insurance right now? I'd say top 3 at least. Mother Nature might still be number 1. Those cat losses have been rough. And most importantly, besides selling a crap ton of umbrellas to help our insureds protect themselves, what can we do about it? Do you think it'll get progressively worse, or is there a way to turn it around? Let me know your thoughts in the comments, and don't forget to subscribe to the Insurance Nerdery, where it is cool to be a nerd. I'll see you next time.
Why? How do you get by?